Hello everyone, welcome back. This is Mayank Kothari, and today in this lecture we are going to discuss about the new concept, that is convexity. We are going to learn the meaning and understand the derivation of the formula so that we get to the logic, straight to the logic of that entire concept. If you remember, by the end of the previous lecture I had told you that convexity is nothing but a modified version of the modified duration itself, which we call it as volatility. And volatility is something which expresses the percentage change in market price. Understand? Percentage change in market price for 1% change in YTM. But there was some problem, or we can say drawback, or we can say loophole in the concept of volatility. The loophole was that when the change in YTM, the change in yield increases, the volatility concept doesn't give us the accurate figure, or it gives the error. I told you I had expressed, or we can say we had discussed about it in the previous lecture when we increased the rate from 17 to 22%. Understand, from 17 to 22%, the actual difference in the market price was 16.03%. But the volatility concept, according to the volatility concept, it was coming to, just a second, 18.15%. You can have a look at this amount. So 3.63 into 5% was 18.15. So volatility was saying that the market price should change by 18.15%, whereas the actual change in the market price was 16.03%. So the 2% error was there, and that's what we have to adjust. In order to improve the concept of volatility, now we are going to discuss about the new concept called as convexity. Convexity will give you a figure of that 2%. Are you getting it? That 2%. It means you will anyhow have to start from the modified duration. You need to know the figure of the modified duration, that is 18%. Right? And from that you will be deducting 2% in order to arrive at the most accurate figure. I'm going to explain this entire thing from the start to the beginning so that you get to know about the concept. So I will be taking some example, and we will be taking around half an hour most probably in order to explain the entire concept. So be with me. What you can do is you can just watch this video at a speed of 1.5 or 2 if you want to revise. If you have enough time, I would suggest you to go with the speed, the normal speed. Let's go. Let's take an example of a bond. Let's say the face value of the bond is 1000 time 5 years. Let's say the coupon rate is 4% will be enough, and YTM to be 7%. Okay, and now let's calculate the market price at this YTM. What will happen? At 7% YTM, the formula for market price of the bond is interest into present value annuity factor at YTM for time 5 years plus redemption value into present value factor at YTM for 50 years. For 50 year or time, right? This is the formula that I will be using. Every year you will be getting a coupon amount of 40 rupees. Okay, let's see. So I can do the calculation here like this: 40 multiplied by annuity factor at 7%. Let me just calculate it fast. Plus 1000 into present value factor 0.713, annuity factor 4.1, and the figure will be 40 into 4.1 plus 713. So it comes to 877. Okay, this is the normal thing. Okay, what else can be done from this point is we can calculate the duration as well. It will be good enough if we go from the start to the end. So we will first calculate the duration, and then we will calculate the modified duration. and after calculating the modified duration we are going to use that. So let's just take this somewhere here and let's do the calculation of duration at this point. Duration is equal to, I will go with the formula, 1 plus YTM divided by YTM minus 1 plus YTM plus outside T in bracket coupon minus YTM divided by coupon outside the bracket 1 plus YTM to the power T minus 1 plus YTM. So it's 1.07 divided by 0.07 minus 1.07 plus 5. Tell me if I'm wrong. Coupon rate is 0.04 minus 0.07 is the YTM. Coupon is 0.04. Inside bracket 1.07 to the power 5 minus 1 plus 0.07 if I'm right. These are all the calculations that we have already discussed, so I'm not spending time on discussing this. Just focus on the calculations. 0.04 minus 0.07 will give us negative figure. Coupon rate minus YTM will give us negative figure multiplied by 5 and then plus 1.07. So the numerator will give you 0.92. Then 1.07 into to the power 5. 1, 2, 3, 4, 5. 1.07 into 2, 3, 4, 5 minus 1 into 0.04 plus 0.07. That's the denominator. Okay, let's solve it fast now. 0.086. So 0.92 divided by 0.086 equals to plus minus plus 15.29. So that will give you 4.59. This is your duration. That is called as Macaulay's duration, right? Now, couple of more things. Once you reach at the duration, we can calculate the volatility also, to which we call it as modified duration, which is nothing but duration divided by 1 plus YTM. 4.59 is the years. It is in years. This is the time in which the present value of the bond is recovered. 4.59 divided by 1.07 comes to 4.29. Okay, great. So this is your volatility. This is one of the important figure. Now this is always represented in percentage, and what does that mean? This is the change in market price for 1% change in YTM. Change in market price for 1% change in YTM. We can represent it as like this. Change in market price is equal to, or like this, modified duration is equal to change in market price divided by change in YTM, if I'm right. So modified duration, change in market price 4.29, change in YTM 1%. So the answer will be 4.29. Basically 4.29 is the modified duration. So whatever the market price is changing with respect to the change in YTM, you are going to put down here and you will get the answer for the modified duration. Now please understand, we can calculate the change in market price as modified duration multiplied by change in YTM. Have a look. If you transfer this change in YTM on this side, you will get modified duration into change in YTM. Okay. So if you are changing, let's say for example, if your YTM is changing by 3%, increase or decrease, whatever, the change in market price will be modified duration into that 3% change. So 4.29 into 3, 4.29 into 3, you will get the change in market price, right? Okay. Now let's do that, and first of all let's calculate the change in market price with actual change in YTM. Let's take YTM as 10%. We have increased the YTM. We have increased the YTM, and if we are increasing the YTM, what will happen? 40 into 3.791 is the 5 years annuity factor at 10% plus 1000 into 0.621. So the answer will be 772.64. Okay, cool. Now let's reduce the YTM. Let's reduce the YTM to 4%. What do you think? Increased the YTM by 3%, decreased the YTM by 3%. What do you think the market price will be? The market price will be 1000 rupees. Why? Because now the coupon rate and the YTM are equal. And if the coupon rate and YTM are equal, first condition. Second condition, the redemption is at par. Then the market price will be equal to face value. So still I'm writing the entire thing, but it will come to 1000. 1 divided by 1.04, 1 2 3 4 5, so plus 1000 into 0.822 and 4.452, 4.452, 178 plus 822, that's 1000, as I told you. Are you getting it? Okay, so now there are three different figures with us. This one, this one, this one, and we are going to name something to these figures. Let's write down. We will call this one as let's say this is present value of the bond when we increased the YTM. Am I right? When we increased the YTM, the present value of the bond is this. Present value of the bond when we decreased the YTM, and present value of the bond without any change means the normal present value at the current yield. So PV plus means when we increase the YTM, what is the present value of the bond? PV minus means when we decrease the YTM, what will be the present value? And PV0 is the present value at current YTM. Okay. Now tell me one thing. How will you calculate the change when we are increasing the YTM? Change in market price when we are increasing the YTM. It's very simple. Have a look. Will you agree with me? Change in YTM is nothing but 877 minus 772.64 divided by 877. But since we want to calculate, since the market price is going down, we want to calculate the change in market price as negative. So that negative sign will indicate that the market price will go down and positive sign will indicate that the market price will go up. So instead of that, what I will do, 772.64 in the numerator minus 877. So once I deduct the smaller figure, keep the smaller figure first, the answer will be negative. So can I write down like this? PV plus minus PV0 divided by PV0. This will give me the change in the market price or the present value of the bond when I am increasing the YTM. Similar will be the case here. If we want to calculate the change when we are decreasing the YTM. So how we are going to do it? It's very simple. PV0 minus PV minus. What does that mean? 877 minus 1000? No sir. We want a positive figure. So PV minus PV0. Do it like this. You will get a positive figure. So PV minus means 1000 minus PV0 divided by PV0. Am I right? The base figure will be 877. So let's calculate this. Let's put down the figures and find out the answer. 772.64 minus 877 divided by 877. So the answer comes to 0.11899. So that will be around 11.90%. It's around 11.90%. actual change in the market price. I will write down. This is the actual change in market price, and you will see the answer will be negative because you are deducting 772, 877 from the lower figure. Okay, do it with the second item. 1000 minus 877 divided by 877 into 100, that will give you 14.03%. So these are the actual change in the market price when you increase or decrease the YTM by, let's say YTM by 3%. Okay, this according to the modified duration, if you simply multiply the modified duration with 3%, this should be the answer. So modified duration, change in market price. So what will be the change in market price according to the concept of modified duration? It's very simple. Change in market price will be modified duration multiplied by change in YTM. The YTM has increased and decreased by 3%. So take 4.29 and multiply it with 3%. See, if you will take 4.29, 4.29 multiplied by 3, or simply I will just write it here itself. 4.29 multiplied by 3. Am I right? Because we are changing the YTM by 3%. So according to the modified duration, this should have been 12.87%. This should also have been 12.87%. But now you can clearly see there is a difference. Modified duration is not giving us the correct answer. Do you agree with this? Because the actual change in the market price is 11.90. You can see almost 1% of the difference is there. And in this case also almost 1 point something percent of the difference is there. So that's what the concept is. Till now, what we have done is the same thing, that what we have done is we just proved that modified duration doesn't give us the correct answer. Modified duration doesn't give us the correct answer. In order to reach at the correct answer, what is the correct answer first of all? Do you agree with me? This is the correct answer because this is the actual change in the market price. And this is the wrong answer. So we have to adjust the wrong answer to certain extent to reach at the correct answer. Okay. So the next step will be to do the plus minus things. Now, what will be, how much will be the change in the first part from 11.90, 12.87 minus 11.90. So do you agree with me on this that we have to add 0.97%. This is the adjustment. This will be called as the adjustment. Minus 12.87 plus 0.97 will give you this much of the figure, 11.90. Do you agree? Okay. Then 14.03 minus 12.87. In this case, 1.16% has to be increased. So both these figures has to be added in this. Add. The moment you add these figures, you will get this. 11.90, 14.03. So can I write down like this? Equals to. So see, what is the formula? This is the actual change 11.90, which is equal to the modified duration. The modified duration 12.87% minus 12.87% plus the adjustment 0.97. This is the actual change in the market price of the bond when you increased the YTM by 3%. And the formula is, in order to change the modified duration, the formula is modified duration 4.29 multiplied by change in YTM plus, do you understand? Plus the convexity adjustment. So there will be 4 things. First, the modified duration. Second, the change in YTM. Third will be the convexity, and that will be multiplied by the adjustment. So that will be called as convexity adjustment. Okay. Now the question is, this figure, has also been arrived by change in YTM of 3%. This figure has also been arrived by change in YTM of 3%. Now, what do you suggest in 12.87? Which figure I should adjust, 0.97 or 1.16? Should I confirm 0.97 or 1.16 as an adjustment? We cannot keep two figures, right? We have to just come to the conclusion that which figure will be called as convexity adjustment. If I go with 0.97, 1.16 will feel bad. If I go with 1.16, 0.97 will feel bad. What to do in such a case? Both the figures have been arrived at by 3% change in YTM. So practically it should have been same, but if it is not same, what should we do? In a simple layman language, I will say go with both. Do the average of both and adjust that in 12.87. You will not get exact figure of 11.90, but now this time you will be much more closer to this figure. Earlier it was a difference of 1%. 1% is very big. We can reduce that difference to just 0.05, 1.10% or something like this. So the adjustment that we will go with is the average of both. We will take average of both. .97 plus 1.16 divided by simple 2. That comes to 1.065. This is going to be our adjustment, 1.065 in the entire modified duration into change in YTM. Have a look. This is nothing but modified duration and this is nothing but change in YTM, if I am right. Okay, now let's just cross check the answers. We will add this 1.065 in both the figures, which is 12.87 and 12.87. We will reach at, the answer will be minus 12.87 plus 1.065. So this comes to minus 11.81. round off, and this will be 12.87 plus 1.065, that is 13.94. Now you can clearly see there is not much of the difference between these figures. 11.90 is much more closer to 11.81 and 14.03 is again closer to 13.94. So these figures are 11.81 and 13.94. These figures are better than 12.87. So this is going to be an improved version of modified duration. When modified duration is adjusted with the convexity, we get better results than this. 12.87 was wrong. So we will just say that this is the correct answer. Now our purpose is to derive a formula from all this discussion. We will start with any of the figure. Okay, we'll start with this 12.87 and 0.11 adjusting by 1.065. We want to come at this formula, come at this figure 11.81%. If we are able to derive a formula of 11.81%, we have reached the destination. So let's start with it. We are going to just write down the derivation here. So we want to find out the change in market price, which was nothing but minus 11.81%. Am I right? 11.81%. This 11.81% was arrived at by minus 12.87 plus 1.065, right? You can take it as 1.07 also in round off. What I will do is here as well I will do the same thing so that there is no confusion. Okay. 0.6 only, so slight variation because it is 0.5 now, 11.0 1.065, so you can take it as 6 also and 7 also. So let's take it 0.6. At that time this will be reached. Okay, 12.87 plus 1.06. Now how did we calculate 12.87? Okay, before moving over to the 12.87, let's write down into decimal. Write it down into decimal. Minus 0.1287 plus 0.0106. This is in decimals, divided by 100. Just divide that by 100. Now how did you reach at 0.1287? It was very simple. This was the multiplication of modified duration into change in YTM. Am I right? This was nothing but the multiplication of modified duration into change in YTM. So I can write it down like this also. Minus 4.29 into 0.03 plus 0.0106. Change in the YTM is this much. Modified duration was this much. So multiplied by 3 will be the change in market price. This is the change in market price according to modified duration. And this is nothing but the change of change in market price. So if I want to write down, it will look like this. This is nothing but change in market price, and this is nothing but change in market price. Okay, this change in market price, have a look. This change in market price was arrived at by modified duration into change in YTM. If you shift that change in YTM to that side, so we can write down this as modified duration into change in YTM into change in market price. But this, understand one thing, if this is the change in market price for 3% YTM, this is the change in market price for 3% YTM, right? We will also call it as for 3% YTM. All the above figures are changing for 3% YTM. Now, if I remove that 3% YTM and write it separately, what will this figure be called as? This is the modified duration, that is the change in market price for 1% YTM. Now it is for 1% YTM. That's why when we multiply it with 3, we will call it as 3%. 1 when multiplied by 3 will be called as 3. So 1 when multiplied by 3 will be called as for 3% YTM. So this is nothing but the change in market price. Change in market price for 1% YTM. Now on this side also, can we remove 3% out of this and write it separately? Yes sir, we can do that. Have a look. Minus 4.29 into 0.03 plus, what if I do it like this, 0.0106 divided by 0.03 multiplied by 0.03. See, when I removed 0.03, this figure was nothing but change in market price for 1% YTM. Earlier the entire figure was for 3%, and once I removed 0.03 out of it, it became, this 4.29 became change in market price for 1% YTM. In the similar way, this change in market price for 3% YTM can be converted into change in market price for 1% YTM. Now this figure, You can clearly say when you divide something by 3, it will result into per unit figure. So this entire figure will be called as change in market price for 1% YTM. Change in market price for 1% YTM. This figure, only this much. Do you agree? So let's write it down. Minus 4.29 into 0.03 plus comes to 0.3533 into 0.03. So I can call this 0.3533 as change in market price for 1% change in YTM. And this change in market price for 1% change in YTM when multiplied by 3 will become change in market price for 3% change in YTM, right? Now, what is the formula for change in market price? See, change in market price for 1% change in YTM. What is this modified duration is called as change in market price. This was change in market price for 3% YTM. This will be called as 4.29 is nothing but change in market price for 1% change in YTM. And that is nothing but the modified duration. So can I call it as a change in modified duration? Yes, sir. So I can call this one also as with another name, change in modified duration, or we can say change of modified duration only for now. Change of modified duration for, now it will again become 3% change in YTM. It is for entirety. Okay. Now we can remove that 3% again outside. Minus 4.29 into 0.03. This is one side of it, plus 0.3533 divided by 0.03 multiplied by 0.03 multiplied by 0.03. Now see, this 0.03 is covered here, and we have added and multiplied and divided again with a new 0.03. So what we want to convert, change of modified duration for 3% change in YTM, we want to convert that change of modified duration for 1% change of YTM. That's why we have divided it by 3. So we have removed again a lot of 0.03 outside, and this has become 1% change in modified duration. Now look at this. This will be called as change in modified duration for 1% change in YTM, and the figure will be minus 4.29 into 0.03 plus 11.78 into 0.03 into 0.03. So that is our ultimate goal. Our ultimate goal is to find out this figure, 11.78. Now let's interpret everything. What do you call 11.78 as? This is nothing but change of modified duration for 1% change in YTM. Then what do you call this 11.78 into 0.03? You can call it as change of modified duration for 3% change in YTM. In another word, it can also be called as change in market price for 1% change in YTM. And then Lastly, what do you call this entire figure from start to the end? This will be called as change in market price for 3% change in YTM. Let me write it on this side. So basically there are three steps: 11.78 and 11.78 into 0.03, 11.78 into 0.03 into 0.03. This figure is called as change in the modified duration for 1% change in the YTM, and this is not in percentage right now. Okay, so when once you multiply it with this, it will become in percentage. So 11.78 into 0.03, that is change in modified duration for 3% change in YTM. You can call it as change in market price for 1% change in YTM. Once you divide this change in modified duration or multiply this change in modified duration with 3%. Okay, now this entire figure is also called as change in market price for 3% change in YTM. Simply this much. Once you go from this point to this point, you will find out the correct answer. Now we can create a formula for change in market price, right? And what should be the formula? See, I will write it here. Change in market price is equal to, it will start with negative sign because YTM is inversely related to market price. Then 4.29 means modified duration. This is also called as annual modified duration. Then multiplied by 0.03 means the change in YTM. What was 0.03? It was change in YTM. This much is done. Or should I write it? Let's take it this side. Then plus. Do you remember this plus sign? Plus sign. Okay. Then 11.78 will be called as convexity. Okay. Multiplied by, can I write down 0.03 as change in YTM and 0.03 into 0.03 and as change in YTM square? Change in YTM square. This is your formula for change in market price. Simply enough, you will have to start with the annual modified duration. This is going to be your first part and this is going to be your second part. So the first part says that you will have to reach out at the real figure or whatever the modified duration is saying, and because this entire 12.87, this will result into 12.87%. Because this is wrong or this is approximate and not accurate answer, we will adjust that and we will keep plus sign only because we have already given minus sign outside this. So we will add the adjustment figure here, that is 1.06 or 06%, right? 1.06%, and that will be calculated as convexity into change in YTM square. Now the only thing left is to calculate 11.78 and we will have to derive that formula, convexity. So let's go ahead and write down that one also. Convexity. I will just start it in the new page. Now tell me one thing. What was the figure of convexity? Convexity was 11.78, only 11.78, and we were calling it as change in modified duration for 1% change in YTM. Change in modified duration for 1% change in YTM. So have a look. Change in modified duration for 1% change in YTM. Right? Can I say change in modified duration by change in YTM? Now, what is the formula for change in modified duration itself? Have a look. Do you remember this formula? Modified duration is equal to change in market price divided by change in YTM. What if I rewrite this formula as change in market price? Like this. Change in market price divided by change in YTM. Now if I add a change on the right hand side, what will be the difference in the left hand side? Can I write it like this? It will be called as change in modified duration. One change has been added here, one change has been added here on the on both the sides. So the formula for change in modified duration will be change in market price divided by change in YTM. Okay, let's take that. It will be called as change in market price divided by change in YTM, and then again divided by change in YTM. If I am right, this much of the part is covered only by the change in modified duration, right? Let's go. Now the question comes to, first thing is, this change in YTM will go down and it will be change in YTM square. The next thing is change in market price. How to calculate the change in market price? First, let me write down like this. Change in market price divided by change in YTM square. Okay. Now, how to calculate the change in market price? We have already seen that it is nothing but the present value, the difference between the present value of both divided by the current present value. This is the change in market price. But we also learned that we cannot take this one only or this one only. We have to consider both, and in fact the average of both, right? So we are going to take the average of these two formulas as well, so that both the sides can be considered. So let me write it like this. Present value when the yield is increased minus present value 0 divided by present value 0 plus present value minus present value 0 divided by present value 0, and the average of both. Am I right? Okay, then divided by change in YTM square. This entire thing is described by the single change in market price. Do you agree with this? Okay, now what will happen? This 2 will go in the denominator. This PV0 and PV0 are common on both the equation. So we can take a common PV0 for both and write down all the numerator at once. And that PV0 will also go to the denominator, and it will be 2 into PV0 into change in YTM square. It will become like this. PV plus minus PV0 plus PV minus PV0 divided by 2 into PV0 into change in YTM square. Now one last step. This minus PV0 and minus PV0 are common. We can take it outside. So PV plus PV minus 2 PV0 divided by 2 into PV0 into change in YTM square. What is exactly this thing? This thing is nothing but convexity. So this is the formula for. You will find out the convexity with the help of this formula first of all, and then you will keep it in the formula of change in market price. See, you will find out the convexity with this formula, and then you will keep that in this formula. You will get the answer. So these are the only two formulas. Let's check these formulas with the institute's formula in our chart. So do you remember this? Convexity is nothing but the present value of the bond when you increase the YTM plus present value of the bond when you decrease the YTM minus 2 into PV0. So do you understand this minus 2 into PV0, the logic of this? Out of these two PV0, one was attached with this one and the other one was attached with this one. Again, both of these equations were divided by 2 because we wanted to find out the average, and that's the 2 here. This is the average. And then this PV0 was in the denominator of this one also and this one also. And then into change in yield square. Okay. This convexity once calculated will be kept in this formula of the percentage change in present value. So understand this first part. Annual modified duration into change in yield. This will give you the inaccurate answer. And because of this part only, we had to adjust it later on. Adjust means plus convexity into change in yield square. Remember this? Annual modified duration into change in YTM plus convexity into change in YTM square. So this is the entire scenario and the derivation. Do you understand the logic of convexity now? I think you are much more clear to the convexity, and I think more than that you are attached to the concept of convexity. In the beginning you were like, I can say most of you were like, what is this exactly the formula, what we are going to do with the convexity and everything. But the main purpose of convexity is to modify the concept of modified duration, improve the concept of modified duration and reduce the error. Reduce the error which is presented by modified duration. It gives more accurate answer, convexity. Okay, so this is the end of this convexity. Let's find out some concept related to the convexity. Let's find out some questions related to the convexity and then just complete solving it. Have a look. So this is going to be our question for convexity. If you remember question number 76, let's start it again. Face value 10,000 rupees to be redeemed at par on maturity. Face value to be redeemed at par, that's an assumption, okay. Coupon rate 8.5% per annum. That means 850 rupees will be 850 rupees will be your coupon amount. Then years to maturity 5 years. Yield to maturity 10%. You are required to calculate the current market price of the bond. You can calculate that. Interest into present value annuity factor plus redemption value into present value factor. Macaulay's duration also, there are 3 different methods of Macaulay's duration if you remember the 3 formulas. Okay, the last one was a little longer. Volatility is very simple. Duration divided by 1 plus YTM, that is 1.10. Then comes the point of convexity. Please understand, for convexity we need 2 more rates at which we can discount. The PV0 can be calculated at this point, 10%, right? PV0 can be calculated with 10%. But what about PV plus and PV minus? Because what is the formula for convexity? Write down. In the compiler itself, write it down. As many times you write, it will be better for you. So it is nothing but PV plus PV minus 2 into PV0 divided by 2 into PV0 into change in yield YTM square. Okay. So but if you will remember, if you will see in this question, there is nothing like PV plus or PV minus or any other hint is given. But you can see there is one thing that is given in the question is present value factor at 10% and present value factor at 8%. So 10% is the PV0. Okay. We can, at this 10% we can calculate PV0. At this 8% we can calculate PV minus because the YTM is reducing. YTM is reducing by 2%. Now tell me, what will be the guessing rate for PV plus? If the reduction is 2%, the increment will also be 2%. The change will be same on both the side. So it will be 12%. Even though it is not given in the question, the only rate that you should take is the 12%. Because 10 minus 2 is 8 and 10 plus 2 is also 12. Okay. So with that, you will have to calculate the convexity. The last one is the expected market price if there is a decrease in the YTM by 200 basis point. Now, if there is a decrease in the YTM by 200 basis point means if it goes to 8% or 2% decrease, what will be the expected market price as per Macaulay's duration? That means this volatility and the actual market price. This will give you the actual answer and this will give you the approximate answer. No need to use the convexity related adjustment in this case. They are not asking us like that. They are just only asking us the change in the market price due to convexity. There is one problem in the answer of this question. although they have said that you only have to calculate the convexity, but they have entirely calculated the convexity adjustment. So in exam we are going to do that only. Let's have a look on the answers now. This process was simple. Macaulay's duration. Which formula has been used here? You can clearly see time into weight. So that is summation of weight into years. Now volatility duration divided by 1 plus YTM, you can calculate it as 3.865%. What is the meaning of this 3.865%? It is the change in the market price for 1% change in YTM. Now is the time to calculate the convexity. Please understand, V plus, you can use any variable. I was talking about PV plus and it is given in this formula as V plus. But you need to understand the logic, not the, you should not remember the words or the letters that are used in the formula. So that is the formula. Okay. V plus will be calculated at 12%, V minus will be calculated at 8%, and V0 will be calculated at 10%. V0 has already been calculated at 10%. You can clearly see 9431.5. In the similar manner, you can calculate here also. My suggestion to you, do not use this table format. It will take a lot of time to calculate the final answer. You can use simply this method. In the 2 steps, you can finally calculate, you can just end the calculation of the present value of the bond at 8% and 12%. So it's better to use the equation method instead of this table format when there is no other use of this table. I can understand the use of the table while calculating the Macaulay's duration because it is related. Okay. But calculating the market price doesn't have any sense in the table format in this 4th part. Now, one more thing where you can save the time. See, at the time of calculation of the Macaulay's duration, you already arrived at 9431.50. Okay, this is the same answer. You can avoid this calculation also if you want to. If you want to, you can save up on the time. Every minute counts in exam. So you need to be very smart in exam so that you can complete your paper of 100 marks and with confidence. So Macaulay's duration, if you use this formula, see, if you use that 1 plus YTM formula, then to altogether this step is required and this step is also required. But if you go with the table format in the Macaulay's duration, you can already calculate, you can obviously calculate the market price. Then why to write all these things? There is no need to as such. Okay. Then comes the convexity. I also told you that it is going to be a waste of time. Table format. Okay. Nevertheless, I am not repeating how to calculate the market price at 8% and 12%. It is very easy. Interest into present value factor, annuity factor plus redemption value into present value factor. You can do that. Now you have all the 3 figures. Put it in the formula. Try doing it at home. There is nothing that I should teach you in this formula. Do you really think I should solve this equation and waste my time and your time also? This is just a plain mathematics. You need to be very careful about the minus signature and the plus sign and the change in yield square. The one thing that you should remember is that change in yield has to be taken into decimal, 0.02, not 2, 0.02, right? If you calculate that, this becomes your convexity adjustment. This becomes your convexity only. Then if you will remember, percentage change in market price, the formula was like that, was like this: annual modified duration into change in YTM. This was one formula, plus convexity into change in YTM square. So this is convexity into change in YTM square, means 0.395%. Write down, just circle 0.395% and write down adjustment required in change in market price, change of market price. This is the adjustment, means whatever 9.867 is something, not 9.867, I will just tell you, wait a minute. What was the modified duration? 3.865, right? 3.865 was the modified duration. So if we go with this, 3.865 into 0.02 change in YTM, the answer would have been 7.73%. Now understand, modified duration is saying that, or volatility is saying that with 2% increase in the YTM, market price should fall by 7.73%. But in reality, this 7.73% should be adjusted with 0.395%. So once you adjust this 0.395, the answer will be like this. $7.335. Understand the difference between these two. 7.335 and 7.73%. 7.73% is the plain answer given by the volatility method, which we say that it is inaccurate. The accurate one is 7.335% after the adjustment of convexity. So this is called as the convexity adjustment. There is one mistake in the answer by the institute itself, and which we cannot help. 9.867 itself is the convexity. 0.395 is not the convexity. There is a difference between convexity and a convexity adjustment. So I will just write it down. If you want to, you can write it in your compiler. Convexity is only 9.867. 9.867. And if you talk about convexity adjustment, it will be 0.395%. So there is a difference in both the figures, but institute is saying that convexity itself is 0.395%, but that's okay. In a sense, you can also say that also, because ultimately we are going to reach to that point itself, 0.395%. So I'm assuming that question was asking about the convexity adjustment itself, and that's why if the question comes in exam, you need to do one thing, find out the convexity also 9.867 and also calculate the adjustment, so that no one can deduct your marks. Did you understand this? Now, expected market price if decrease in YTM by 200 basis points. See, if YTM is decreasing, market price will increase. Macaulay's duration based estimate says that 3.865% volatility. It means volatility, because volatility is calculated with the Macaulay's duration only, na? So they are saying to calculate, they are asking us to calculate the new market price or the change in the market price according to volatility method. So 3.865% is the change in the market price for 1% YTM. For 2% YTM, 3.865 into 2. This is going to be 10160.55. It says that 729 market price should increase by 729%. Increase. Why increase? Because YTM is falling, the market price will rise. By intrinsic value method means the simple interest into present value, annuity factor plus redemption value into present value factor. The real method, you can say. So the real value is 10,204. The difference between these two is called as the error. And that error is mostly solved by the convexity method. Okay. So the expected market price should be 10,204. Let me just cross check the convexity adjustment method. In the last page we calculated this real rate should be 7.335%, right? So what I will do is, I will have to calculate it again. Why? I will tell you. Or we have to make the changes here, because the last part which is asking that the YTM will decrease, so we will have to take the impact of decrease in YTM. So this YTM will be minus, this will become minus, this minus and minus side will become positive, and ultimately this will also increase. The 7.335 answer that we calculated at that time was right, because we were assuming the increase in YTM by 2%. But last question is saying as the decrease, and that's why we are changing the method. So 7.73 plus 0.395, that goes to 8.125%. So if you will increase, just increase plus 8.125% in the real present value 0, current market price 9431.50 plus 8.125%. The answer will be 10,197.81. Now have a look. The answer is 10,197.81. Now can you clearly see this answer is very close to the real answer, actual answer of 10,204, but the answer by Macaulay's duration or the modified duration was little more we can say error, or it was inclusive of error. Got it? Question number 77 is going to be the next question, and that is your homework. Why it is homework, sir? There is nothing else that we can discuss in this question, so let's just finish it as soon as possible. Face value 1000, coupon rate 7%, maturity 7 years, YTM 8%. Okay, can you calculate the market price of the bond? It's very easy to calculate the market price. Everything is given. Duration, we have 3 different methods. You can calculate by any of the method. And then they are saying if there is an increase in yield by 35 basis point, that means 0.35%, what would be the price of the bond? Whatever it is, you will have to do one thing. After calculating the duration, you will have to calculate the volatility. Volatility multiplied by 0.35 will be the change in the market price. And see, yield is increasing, the market price will decrease by this much percentage. It's easy, we have seen everything about it. So this is going to be the market price. Then duration, as usual, the same method of duration, 5.73 years. Then you will have to calculate. Please understand one thing. There is some do not use this method, don't. Although institute has given 930 is the proper answer. See, let me tell you one thing. 930 is the accurate answer, but that is not what institute is asking you to use. Because 0.35, first of all, 0.35% change in YTM is very less. There will be almost nil or no error if you use the modified duration or volatility concept with this. Okay, so use the volatility concept now. Calculate the volatility. Volatility is nothing but 5.73 divided by 1.0838%, right? So 5.73 divided by 1.08, that goes to 5.31%, will be the change in market price for every 1% change in YTM. But YTM is changing by 0.35 only. So multiply this by 0.35 and you will get 5.31 into 0.35, 1.8585. And YTM is increasing, market price will decrease by this much percentage, 1.8585. So what you have to do is this much of the price less 1.8585 will be your answer. 948.56 less 1.8585%, 930.93. Now, do you really think this is the answer by modified duration, 930.94, and this is the real answer, 930.15? What is the difference in that? The error is almost nil because the change in market, change in yield is very less. Okay. My suggestion to you is this is the only approach you should use. Use this in exam. See, you can calculate the ultimate result in very less time. This is going to take a lot of time and we don't have to use this. Why we don't have to use this, sir? Very simple. Question is asking us to calculate the duration and then they are asking us to calculate the new market price for the change in yield. That means they want us to use the volatility concept. The concept is built for that only. Okay, sir. Let's move ahead. This is also a simple question. Let's have a look. 5% bond. So 5% is the coupon rate. Can I say that? Face value 1000 being traded in the market at 1000. See, have a look. 1000 is the face value. 1000 is the market price. That means face value is equal to market price. That means if the bond is redeemed at par, coupon rate is equal to YTM. Okay. Redeemable after 10 years at par. See, at par. Find out the duration of the bond if the required rate of return of the YTM is 5%. Even if they would not have given this statement now, still we would have taken 5% only because we have the extra knowledge of this relationship. Please understand, in the next time they ask this question in exam, they might skip this sentence just to check whether you have the knowledge of the relationship between YTM and market price or not. So if the face value is equal to market price and it is being redeemed at par, the coupon rate will be equal to the YTM. And they want you to calculate the duration by shortcut method. Okay. Also find out means another, you can calculate it one more time. So Macaulay's duration with the normal method is this. There are three different methods that you can use for the duration. Summation of present value into year divided by summation of present value, summation of weight of the present value into year, and this shortcut method. In this question, this method has been used, where they have calculated summation of present value into year divided by summation of present value. Instead of this, you could have taken 1000 directly and the answer by the shortcut method. This is called as the shortcut method, the third method that we were talking about. And that's why I told you, if you want to save up on time and you can remember the formula and the maths is also good, then you should use this formula instead of doing all this calculation, because it may seem a table only, simple table only, but it will take a lot of time to do the calculation. Why? I will tell you. See, every time you will have to press something on the calculator and write down all these figures. After that, 50 multiplied by 0.952 on the calculator, write down this. Then this. For 10 years you are going to do this. And then again, present value into year, present value into year. So there will be a lot of time involved in the exam. Unless and until you remember this formula, you will end up spending a lot of time. So practice makes one perfect with this. Without looking at the answer, you should be able to practice it. I'm moving over to the next question. Nothing's new in this. Okay, come over to question number 79. We'll see what we can do. Whether we have to take up this question or just put it for homework. An investor has recently purchased substantial number of 7 years 6.75% 1000 rupees bond with 5% premium payable on maturity. It is not redeemed at par. Okay, first of all, this is the original maturity. This is going to be the coupon rate. This is the face value. 5% premium means it will be redeemed at 1050 rupees. Am I right? It will be redeemed at 1050 rupees at maturity after 7 years. Okay, now premium payable at maturity at a required yield of 9%. However, due to a financial crunch, he is looking to sell these bonds. He had already purchased these bonds and he was about to keep it for 7 years. But there, after some years, I don't know when, after some years, he was facing some financial crunch. He need money, and that's why he has to sell these bonds to someone else in the market, and has got a proposal from another investment who is willing to purchase these bonds by selling out a maximum amount of 897 per bond. And there is a purchaser available in the market who is interested in our bond, but he is going to pay only maximum of 897 rupees per bond. Investors follow intrinsic value method for the valuation of bond. You are required to calculate the market price, duration and volatility of the bond. First of all, you calculate the theoretical market price. See, this is the actual market price given in the question. You take 9% and then find out what is the theoretical market price, then duration and then volatility of the bond. Okay. And required YTM of the new investor. Now, please understand. What is the second part which is asking? This is the first part according to the given YTM, 9%. Okay. But second part is according to the new investor. If he is willing to buy the bond at 897%, what is his return in this? So by buying at 897%, how much exactly he is earning? 9%? No sir, he is not earning 9%, because if we discount the cash flows at 9%, the present value should come to 897. So we have to find out a new discounting rate, a rate at which the present value of cash flows will be equal to 897. So this is nothing but calculate using the IRR method, trial and error method. Please write down. You will have to do trial and error here. Now, second part, what is the relationship between the price of the bond and YTM? Inverse relationship. Price of the bond and YTM carries inverse relationship. Just a second. That's very simple. I think the first part is very simple. The second part I can involve myself into. Okay. First of all, market price of the bond at 9% YTM. Have some analytical understanding. You are going to use the same method of calculating the market price, that is interest into present value annuity factor plus redemption value into present value factor. Many times we have used this formula, so that's why I'm not repeating. 1000, what is exactly they have done? Let me check. I don't know what, but please remove this thing. This is only one part. Or instead of removing, what you can do here is plus 1000 redemption value into PVIF 9%, PVF %, 7. Write down. See, 1000 into 6.75% into present value annuity factor is just one thing. This much, the present value of interest. Where is the present value of redemption value, right? Also, redemption is not happening at par, so it will be 1050. This thing. So please write down this particular thing. Write down the formula. Every time you solve the questions of market price of the bond, please write down the formula first and then start solving it step by step. So let's assume that this is going to be the answer 914.01. Okay. If the return in the entire bond is 9%, then it is worthwhile to purchase the bond at 914.01 maximum. If you are able to purchase the bond at a lesser price than this, that means you are earning more, the purchaser. Now there are two people in this question. Seller, buyer. See, buyer is purchasing it at 897. In order to earn 9% return, he can maximum pay for 914.01. That means if he pays more than that, the return will be lesser than 9%. But you can clearly see that 914 is more than 897 that he is paying. That means he is paying lesser amount. The lesser amount he is going to pay, the more will be his return. So I'm sure about one thing, his return is higher than 9%. Okay. Now this is the second part, duration at 9%. You can use the 1 plus YTM formula also to calculate this. Otherwise, summation of weight into year is also okay. The duration comes to 5.7579. This divided by 1 plus YTM will give you the volatility. This divided by, where is the volatility? Okay, the C part is missing in here. Let me just write down. C part is missing in the compiler. So please write it down by yourself and make it D, or we can say second part. So C part is volatility. Duration divided by 1 plus YTM. Duration is 5.72, YTM is 1.09. The answer will be 5.25. This is the percentage of change in the market price for 1% change in YTM. Okay. Now comes the required yield of the investor. You have to do the IRR method. See, clearly you can see one rate was 9%, at which the market price was 914.01. Now you can use the volatility method also instead of IRR. There are two methods that you can use, IRR method also and the volatility method also, to find out the YTM. But let it be, you go with the IRR method only, that will give you the correct answer. Now see what has been done here. NPV at 9% is equal to 914.01 minus 897, which is equal to 17.01. Instead of using this, I will just clearly say one thing. At 9%, the NPV was 914.01. You want to bring it down to 897 because you want to know what is my return if I buy the bond at 897. If I'm buying at 914, I'm earning 9%. If I buy at a lower price, the earning will obviously increase. So what is the earning at 897? You want to decrease the price present value. That means you will have to increase the YTM. The next thing that they did is they increased the YTM to straight away 12%. You can take 11%, 12%, 13% as well. When they did that, they found that 12% is too high, man. See, 782 is a big difference from 897. So my suggestion to you, after 9%, go with 11%. 11% is enough. So at 11%, let me do my own calculations here. At 11%. Because practically there are very less chances that a student will jump to 12% directly from 9%. So it's better to go with 10 or 12, 11%. 1 divided by 1.11. 1 divided by 1.11. 1, 2, 3, 4, 5, 6, 7. So 67.50 into plus 1050 into 0.482. MRC 4.712. into 4.712, 318.06 plus 506.1. So that's 824.16. Now you can clearly see we can use the interpolation technique. What is going to be the technique? Sir, have a look. At 9%, your market price is 914.01, and at 11%, your market price is 824.16. Your purpose is to bring it down to 897, and you can clearly see the difference between 897 and 914 is very small. And if it is small, the change should also be small. So 9 to 10% would have solved the problem, I think now. Okay, but still, let's go with this. 2% increase in the YTM brought down the market price by 10, just a second, 89.85 rupees, whereas we wanted to bring it down by 17.01 only. So let's start this divided by this multiplied by this. Simple. So start with 9%, then say 2% increment brings down the market price by 89.85 rupees. So how many percentage of increment will bring down the market price only by 17.01? This is interpolation. 9.38% is your answer. So more appropriate answer is 9.38%. So you took 12%, you took 11%. Even if you take 10%, the answer will still be right, 9.3 something. So this was all about it. The relationship between the price of the bond and the YTM is opposite or inverse. Same thing. Nothing's new. Question number 80 is homework. Apply some brains. Again, you will have to calculate the YTM with this interpolation technique. Use it and you will get an answer. 4.20% will be the YTM, and then you will be calculating the duration twice by using 4.2% in both. See, so nothing's new in this. Question number 81. Have a look on 81. Excel Ispat has made an issue of 14% non-convertible debentures on January 1, 2007. I will talk about non-convertible and convertible debentures later on. In this question, it has not much of a relevance. So understand this from a point of view of a normal bond. Yeah, but 14% is something which is coupon rate. On January 1, 2007, these debentures have a face value of 100 and is currently traded in the market at 90. So if they are trading in the market at a lesser than face value, the YTM will be higher than coupon rate if the redemption is at par. Interest on these non-convertible debentures, this is called as non-convertible debentures, will be paid through post-dated checks. That means I will write down all the checks for the future, like the interest which is payable 2 years later, 3 years later, and whenever. I will just write down all the checks. I will just put up post-dated checks. Post-dated checks means I will put a future date on that. What happens if I put a future date on a particular check? That check is irrelevant until that date comes in the reality. So suppose for example today is 1st January 2023 and I write a check with 30th June 2023. That means that check to whomsoever I will give, that check is irrelevant till 30th June 2023. So post dated check has no value till that particular date comes. Okay. So interest on NCDs will be paid through post dated checks dated June 30 and 31. That means what? In a year, the interest is paid twice. In a year, the interest is paid twice, June 30 and December 31. This is a semi-annual interest payment question. Okay. Interest payment for the first 3 years, that means 6 interest payments. Every year twice, in 3 years, 6 payments. So 6 checks will be issued for every investor. Will be paid in advance through post-dated checks. Now this is written just to confuse you. It is clearly written will be paid in advance. But it is not a reality because that advance checks that has been given today for the next 3 years has no value until that date comes. So it's not an advance payment first of all. The payment will be made on the due date only. While for the last 2 years, post-dated checks will be issued at the end of 3rd year. So this entire story has no relevance. Except for one thing, which we get to know from this statement, that the interest will be paid half yearly. The bond is redeemable at par. Understand? 1000 rupees will be, no, 100 rupees will be received at the end of 7th year. On December 31, 2011, not 7th year, it's just 5 year. Okay, so this was January and this is December. So entire 2007, 8, 9, 10 and 11. So 5 years period is there. You have to calculate the current yield and YTM of the bond. What is the current yield? Very simple. Interest divided by market price. Interest 14 divided by 90. 15.56%. But sir, you said that interest is paid half yearly, then why are you not taking half year interest? You can take it. In current yield, if you take half year interest or a full year interest, it doesn't matter. So 7 divided by 90 will give you 7.77%. This is your current yield for 6 months. Why for 6 months? Because in the numerator you have taken half year, the final answer will also be of half year only. And then you multiply it with 2 and you will arrive at 15.56% per annum. So there is no difference in the formula of current yield when the interests are paid half yearly or per annum. The second thing that they are asking you to calculate is the YTM of the bond. See, YTM of the bond has to be calculated like this, 81. You can calculate it with the average method also, with the discounted cash flow method also. So average method, coupon plus redemption value. If you remember this formula, we are using it after a long period. And redemption value plus market price divided by 2. So coupon period for half year is 7. Half year payments are there, so take half year only in the numerator. Okay, 7 plus redemption value 100 at par. Market price today 90. How many number of periods are there for the coupon payment? 10, not 5. Because you are taking half year coupon payment, then take half year capital appreciation. So capital appreciation should also be taken half yearly. How many half year periods are there in 5 years? 10 divided by 100 plus 90 divided by 2. So solve this question. 8 divided by 95. That is 8.42% per annum. Sorry, not per annum, for 6 months, semi-annually. So in a sense, if you reinvest that, your answer for per annum will become like this: 1.0842 square, because there are 2 half years in a year. 1.1755, that is 17.55% per annum. Let me first check the answers in the institute module. So they have calculated it half yearly only. They have used the interpolation method. My suggestion to you, don't go with the interpolation method in this question, at least unless and until anything else is asked. I think there is something which is asked, is the calculation of the duration of the non-convertible debenture. Now for that purpose you will have to use the table, so it is going to take a lot of time than you are expecting. So have a look. First of all, the current yield was 15.55, that was right, okay. And then the YTM is the double of this, not 8.5 but okay, let's do that. This is not the final answer, this is for half year only, half yearly. 8.5154, half yearly YTM is 8.541%. so there is one correction that you need to do. Correction means an addition that you need to do, which is going to be like this. Therefore per annum will be 1.08541 square, that's 1.1781, that is 17.81%. Why square? I will tell you. See, if you will receive 8.54% in that half year, I am assuming that you are going to reinvest it, you are not going to keep it, so you don't have any cash flows, 0, and then you invest 8.54%, so you will get 8.54% on the principal and the first half year interest also. So at that time it becomes 8.0854 square, because you are getting it twice. And the second 8.54% that you are receiving is on the principal amount also, that is 100 rupees or 90 rupees, sorry 100 rupees, and then this interest also at 8.54%. So this is interest on interest, compounding effect. Okay, nevertheless, the second part of this question says about the duration of non-convertible debenture. Now understand, this is the first question where we are facing this problem or the situation where the duration has to be calculated with half yearly coupon rate. Now understand, the duration that you will calculate will take into count this 10 numbers. That means the duration that you will achieve will have to be cut down by half in order to convert it into years. The duration that you will get will be half year periods. Suppose the duration is 7.5, that means 7.5 times half years, that is 3.25 years. Okay, so let's write down the duration. Let's first look at the duration calculation. See, you can clearly see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and please correct this. This is not year, this is period. Now you can say period, this is not year. Okay, write down, cut it and write down period. Then cash flows given to you, every half year you are going to receive 7 rupees, and then in the last year 107 rupees, that's okay. Present value factor you are calculating at 8.54%. Please understand, because you are taking half year rate, because you are taking half year cash flows, the rate applicable will also be half year for discounting. If you remember, in the beginning we did that. One of the question was 6% and 3% YTM that we took. Okay, So if you want to discount half year cash flows, the interest discounting rate should also be half yearly. So we did that. Then we calculated the present value. Then what we did in the next part is we calculated how much of the present value of the total is recovered in first year. So this is nothing but the weight, and this weight is then multiplied with the year or the period to arrive at 7.3654. These are half yearly periods. Write down half yearly periods. So you will have to cut it down by half. Duration is 7.3654 for half years, not years, half years. So cut it down by half and you will get the yearly calculation. Most of the students made this mistake while calculating the duration. They were in hurry in exam, and what they did is they just wrote in the exam like 7.3654 years is my duration. How can be the duration is 7.36 when the total maturity is 5? If you remember that particular question where we said that the duration of the coupon paying bond should always be less than the maturity. If the maturity is itself of a 5 years, how can the duration will be 7 point something years? The duration will be lesser than 5 years, which is 3.683. Okay, the next question that they are asking us is they want us to calculate the realized yield. Do you understand the meaning of realized yield? There was one question in the past in this chapter itself where we calculated the realized yield. That means that whatever we were receiving in between was reinvested back. But in that question, there was a separate percentage of reinvestment, which was 16%. Here, there is no separate percentage. Okay. Assuming that the intermediate coupon payment, what they are saying, are not available for reinvestment. That's why. Understand. We were assuming in that question that the 150 rupees of the coupon that were received every year was reinvested at 16%. That's why we took all the cash flows till the end. But in this question, the no reinvestment rate is available because they are saying that it is not available for reinvestment. So you just collect it and keep it with you and then take it to the end. So how much you have received by paying 90 rupees today, how much you have received in terms of interest 70 rupees, and at the end 100 rupees. So in the beginning you paid 90 rupees and in the end you have 170 rupees. The question is asking you this only 1, 2, 3, 4, 5 years. If you paid 90 in the beginning and you are getting 170 at the end, what is the per annum return that you have earned? Why we are taking 70 and 100? Why we are not taking interest on 7? Because that is not available for reinvestment. So we are not able to reinvest all these cash flows. That's the loss to us. We will just keep it in the pocket and we will just open it after the end of 5 years and we will see that we only have 170 rupees. So you have to use the compound amount formula. Compound amount is equal to principal in bracket 1 plus r to the power. You can take it half yearly also, to the power nt rn. As because it is semi-annual payment, you will have to use this formula. See, 1 plus r divided by n to the power nt. Now 170 is the amount that you received at the end of 5 years. 90 was your investment. 1 plus r, number of compounding in a year is 2 divided to the power 2 into 5. You will say that there is no compounding, sir. Yes, compounding will be there. This is reinvestment, which is different. Compounding is different. 170 divided by 90. This is 1.888 to the power 1 by 10. 5 into 2, 10. So 1 by 10 is equal to 1 plus r by 2. Am I right? So let's calculate 1.888. How do we calculate that? It's very simple. 1.888 in the calculator, 12 times square root, and then minus 1 divided by 10 plus 1 into equal to 12 times. Let me do that. 1.888. The answer comes to 1.0656 is equal to 1 plus r by 2. If you take 1 on this side, it will be deducted, so answer will be 0.0656 is equal to r by 2, and the 2 when comes to this side will get multiplied. The answer will be 13.12%. Let me check what is the answer by the institute. It should have been 13.12%, but they have not taken it as this is wrong, I can clearly say. Let me once check. $6.56. No, not wrong. This is right. Not wrong. Up till this point, everything is right. Okay, 1 plus r to the power 10. This r is half yearly because they have not divided it by 2. So I can say this entire r is half yearly, and the r is coming to 6.380. Their answer is coming to 6.380. Why, I will tell you. They might have taken 170 by 90 in totality. So I took 1.888. They might have taken 1.889 in rounding off, and that's why some error is there. Otherwise the answer is almost same, 13.12 and 12.76, almost closer. So that's just the compound amount is equal to principal in bracket 1 plus r by t. Many students asked me, what is this new formula, sir? It was the time value of money which you learned in the beginning. Okay, let's have a look on question number 82. This is also an interesting question. Find the current market price of the bond having a face value of 1 lakh rupees redeemable after 6 years maturity with YTM at 16% payable annually, and the duration is also given. See, they want us to calculate the market price. Question number 82. Okay. They want us to calculate the market price. Please understand patiently. The formula for market price as usual is interest into annuity factor plus redemption value into present value factor. Okay. Redemption value is 1 lakh, and we can calculate the annuity factor also at 16% for 6 years. So have a look. 1 divided by 1.16. 1, 2, 3, 4, 5, 6. Sixth year factor is 0.410 and the annuity factor is 3.685. The only thing which is missing in here is the amount of interest, because there is no coupon rate given in the question. But instead of that, they have given you one more detail which you don't know why. That is duration. Okay, with the help of the duration, what you can do, you will have to find out the coupon rate. Once you calculate the coupon rate, you can apply it on 1 lakh rupees and then you can find out the answer. So see, there is one way to calculate that. Duration. If you remember, duration is equal to 1 plus YTM divided by YTM minus 1 plus YTM plus T in bracket coupon minus YTM divided by coupon in bracket 1 plus YTM to the power T minus 1 plus YTM. Now if you start putting up the figures, it is 1.16. Be careful about while solving this. Minus 1.16 plus time is 6 years. Coupon amount we don't know, or coupon rate we don't know. YTM is 16%. Again, we don't know the coupon. 1.16 to the power 6 minus 1 plus 0.16. Okay, let's start solving it. It goes to 7.25 minus, the numerator will look like this. 1.16 plus 6c minus 6 into 0.16, that's 0.96 divided by. The value of 1.16 to the power 6 is given in the question. Let me once check if it is right or not. 2.4364, right. So I can just put it here. So it will look like this. 2.43 C in bracket 2.4364 minus 1. So should I write it as directly as 1.4364C, the entire answer, plus 0.16. And one more thing, the amount of answer for the duration is 4.3202. 4.3202. If we solve this equation, we can get the rate of coupon easily. So first of all, transfer this 7.25 on this side. The answer will be minus 2.9298 is equal to minus. The numerator is 1.16 minus 0.96. It will be 0.20 plus 6C divided by 1.4364C plus 0.16. Now you can clearly understand that this minus and this minus signature will automatically get cancelled. Then you can take the denominator on this side and multiply it with this. So I will just write down the answer directly. This will be 4.2084C plus 0.4688.20 plus 6C. Now we can clearly bifurcate the C part on one side, take the C part on one side and rest on the another side. So what I will do, I will just transfer this 4.20 on the right hand side and 0.20 on the left hand side. The answers will be 0.4688 minus 0.20. It will be 0.2688 is equal to 6 minus 4.2084, 1.7916C. So the C will be 0.2688 divided by 1.7916. It goes to 0.1500, that is 15%. How simple it is. But you need to remember the formula. That was something new in this question. But yeah, there is another method. If you want to go long, like you want to do some more calculations, there are some chances that you may end up with some calculation mistake. There is another method to find out the amount of C. See, this was something that we discussed, and C was 0.15, 15%. You take 15% of 1 lakh as 15,000, take annuity factor, 1 lakh into present value factor, your answer is here. Another method is to take X. Let X be the annual coupon payment and just go by the method of this. Summation of present value into year divided by summation of present value is equal to duration. Start doing all the calculation according to this method and put coupon amount as X. Put coupon amount as X. The moment you start putting coupon amount as X, what will happen? You will multiply the present value factor with X and you can write it as like this: 0.862X, X, 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 and then, oh shit, I think I will not repeat that again, sorry. 0.410x plus 41,000, and this is the total of all this. This is the total of all this. So you put this figure divided by this figure. This figure is the present summation. What is this? Summation of present value into year, and in the denominator it is summation of present value and the 4.3202. If you solve this question, the X will be somewhere around 14,983, which you can take it as 15,000. Not exactly the correct answer, but approximate, and then the answer will be same, 15,000. Okay, let's move on to question number 83. Have a look. Please take your time. I think I should also, but let it be. Take a break and then come back. It will be all fine because we are moving fast from 76 to 82. We have completed a lot of questions because there was nothing new to discuss in that. In this question also, there is nothing new. Convexity is convexity questions will be there after a couple of questions. Okay, Mr. A will need 1 lakh rupees after 2 years, for which he wants to make one time necessary investment. Understand? Mr. A will need 1 lakh rupees after 2 years, for which he wants to make an investment today itself, one time, not like systematic investment plan. And he has a two choices of the bonds. Their details are as follows: bond X and bond Y have both the same face value. Coupon rate is different, 7% and 8%. So once you invest in bond X, you will be getting 70 every year, 80 every year. Years to maturity. Bond X 1 year, bond Y 4 year. What does that mean? If you need 1 lakh rupees after 2 years, and if this bond is only till 1 year, how can you invest in that? We can do so. After 1 year, when the bond matures, I will assume that this bond will again be available for another 1 year, right? And bond Y, if you invest in 4 years maturity bond and you want money after 2 years, what is the solution? Sell it in the market to someone else. Don't wait till maturity. Current price of the bond is given to you and the current yield is also given. That's very good. Advise Mr. A whether he should invest all his money in one type of the bond. There are two things. Should you invest all your money in bond X or bond Y? Or he should buy both the bonds. And if you are saying that he should buy both the bonds, how much percentage of his total wealth should be invested in bond X and bond Y? If so, in which quantity? Assume that there will not be any call risk or default risk. See, do you remember the question of callable bonds, where company had the right to call back the bond before maturity, and at that time investors' plan may get affected? So that is not the case in this question. That's why they are saying that there is not any call risk. The company is not going to call the bonds before maturity. And the second one is default risk. The company is not going to default. That means every interest payment will be made on time. So 3 options. A, 1, invest entirely in X, invest entirely in Y, and some percentage in X and some percentage in Y. Now you will learn something new, which you have learned in the very first one of the first lectures, which was portfolio return. How did you calculate the portfolio return? It was summation of weight into return. So you calculated the weighted average. In this question also, what you are going to do is, you are going to calculate the weighted average duration of your portfolio in this, and it should come to 2. Why? Because you want the money after 2 years. So you will invest in every bond in such a manner that the weighted average duration of the bond should be 2. So see, have a look. The purpose, please write down in this question itself. Purpose, weighted average duration should be 2 years. See, there is one concept called as duration, which shows that how much time is being taken by the bond to recover its true cost, means the present value. Okay, but if we form a portfolio of our own, at that time there is no duration available in the market that we have to calculate according to our investment. So we can apply the same concept as we used to apply to the portfolio return. Portfolio return was nothing but the weighted average of the returns of individual securities, right? If there is security 1 and there is a return, if there is security 2 and there is a return, we used to do the weighted average of both the returns to calculate the portfolio return. Understand this question as a portfolio duration. What is the formula for portfolio duration? Weighted average. If you, instead of write down duration, it will be summation of weight into D. So first you will have to calculate the duration of X and Y and then put it 2 here. Because you want the money after 2 years anyhow. So you will be selling all the bonds after 2 years. So you have to understand that the duration, weighted average duration, the amount that you are going to invest in each bond should be such that your money is recovered on an average in both the bonds after 2 years. Okay. See what has been done here. The very first bond, that is bond X, is very simple because the maturity is 1. The maturity is 1. You can clearly see you will buy the bond here at 972.73. Okay, and you are going to receive the coupon amount of 70 rupees here and 1000 rupees here. So the duration of the bond automatically becomes 1 year itself. There is nothing else that we can do. There is no other cash flows. So we cannot do weighted average of the years. Duration is weighted average of the years. There are no years. So only 1 year. 1 year consists of 100% weight, and that's why the duration itself is a 1. In the 1 year bond, the duration will always be 1. Getting it? Come to the second point. Bond Y. 4 years maturity, the cash flows, present value factor at 10%, proportion into years, and then comes the average duration, weighted average duration. So the duration of bond X is 1, duration of bond Y is 3.563. What you can do is like this. Bond XY, okay, duration 1 and 3.563. Let's say the weight, the amount that you are investing in the bond X is, let's say, W, because that's what we want to find out, right? The total weight will be 100%. Do you agree with this? The total weight will be 100%. So if you have 10 rupees and you are investing 4 in X, the balance will be 10 minus 4. So I can write down 1 minus W. W plus 1 minus W is 1. 100%. So if in a portfolio of 2 bonds, if the weight of the one bond is W, the another will be 1 minus W. So what you have to do is weighted average duration, W into D. This should be 2. This should be 2. So 1 into W, W plus 3.563 into 1 minus W. So you will just find the same thing here. Instead of W, they have taken as X. Okay, I purposely, deliberately, I didn't take X because X was the name given to the bond. So I can write it down in my wordings as W plus 1 minus W into 3.563. When you solve this, you will get the W. That means 61% of the total investment. 61% of the total investment should be in bond X, because that was the weight of bond X. So if 61% of the total you are investing in bond X, 39% will be invested in bond Y. But the question is not asking you about the weights. Understand? They are asking you about how much quantity you should purchase of every bond. It's very simple. If you have 1 lakh to invest, you can clearly bifurcate that. Okay, one more thing. If you have 1 lakh, you don't have 1 lakh to invest. You need 1 lakh rupees after 2 years. And the yield is 10%. Now understand how much you should invest today. You should invest the present value of 1 lakh rupees today, so that after 2 years at a yield of 10%, it should become 1 lakh. So if you will see, if you will take 1 lakh rupees that you want here and you want to invest 61% here and 39% here, it is very clear that you are not going to invest 61,000 today. You are going to invest the present value of 1 lakh, which is 0.909 and then 0.909 again for every year. That means 0.826. That is 82,600. If you will invest 82,600 at 10%, after 2 years, it will become 1 lakh, which is exactly you want. Okay, so 61% of 82,600 should be invested in X and 39% of 82,600 should be invested in Y. Simple. So you will get the amount. Have a look on this now. 1 lakh for 2 years at 10%, 61%. 1 lakh for 2 years at 10%, 39, sir. So 50,000. See, very simple. 1 lakh into 0.826, 1 lakh into 0.826, that means 82,600 into 61% comes to 5386, and then 39% comes to 32,214. This is the amount that you will be investing today in every bond, and this amount divided by the current market price at which you will be buying the bond. So this bond divided by the current market price, and this bond divided by the current market price. Ultimately you will get to know about how many bonds that you will have to purchase today. 51.80, you cannot purchase the bonds in decimal, so that's why you have rounded off to the next multiple, that is 52. In this case 34.40, you can write 35 also or 34 as they said. So these many bonds have to be purchased. This is the final answer. Again, going from backwards, these are the number of bonds that you wanted to purchase. If you buy this much of the bond, you will be buying at this price. That means you will be investing this much of the amount, and this amount plus that amount, 5386 plus 32214, together becomes 82600, and 82600 in 2 years will become 1 lakh, exactly what you need after 2 years. Got it? Now, there are a couple of assumptions that bond X is for 1 year maturity. So the assumption is that it will be reinvested. After 1 year, the same bond will be available for another 1 year. See, the investor can invest in both the bonds with the assumption that bond X will be reinvested for another 1 year on the same return. Otherwise, we cannot help it. Then the bond Y only will be the option if you don't take this assumption. So this is how what you need to do. This is going to be very important concept that you are learning here, which will be used in the immunization concept, bond immunization. This is what you did here, bond immunization. That means your target period was 2 years, and that's why you created a portfolio in such a manner that whatever you need after 2 years should be received in that portfolio after 2 years. So that is weighted average duration. Your target should be equal to the weighted average duration. That's it. Question number 84. 84 is up to you. You are going to take it as homework. It's very simple. I will tell you. It is nothing but the present value of future cash flows. See, someone is G holds the following securities: bond A, B and preference shares C, D. And they are asking you to calculate the current value. Current value means you have to calculate the present value of all this. Okay. For the time being, forget about the numbers. Multiply the number of bond A, B, C, D at the end only. Calculate the market price, current market price today. Now see, you can calculate the current market price of these two bonds because these two bonds are having some coupon rate and the maturity. So these are redeemable. But these two bonds are irredeemable, or we can say the preference shares are irredeemable because there is no maturity. So perpetuity formula will be applicable in these two, which is nothing but preference dividend divided by the cost of preference, which is 13%. Very simple. Okay. And what is the preference dividend in this case? 100 face value multiplied by 11, that means 11 rupees, divided by 13% multiplied by 1000 number. Have a look. 11 rupees into 1000 into 100 in total number divided by 13%, 12% divided by 13%. That's it. Very simple, nothing else. At the end you multiply it by 1000 number, and in these two parts it's very simple: present value of interest and redemption value. You don't have to show so much of the things here. Just write down interest into present value annuity factor plus redemption value into present value factor. Calculate for both and you will get the total. So I'm leaving this question 84, 85 to you. 85 is also the same. Question number 86, 87 and 88 are now going to be the convexity related questions. Have a look. Small questions, very small. Just put the formula and you will get the answer. But it is worthwhile to understand everything. A bond is currently trading at 98.722 for 100 per 100 for of par value. So I can write down this is PV0, this is face value. If the bond's YTM rises by 10 basis point, that means 0.10%, or we can write down at 0.0010 if I'm right. Yeah, 0.001. The bond's full price is expected to fall to 98.669. Understand what is given to you. PV0 is equal to 98.722. Then they are saying change in YTM, and that too increase is 0.001, or we can say 0.1%. Then PV plus, because YTM is increasing, the bond price will fall to 98.669. If the bond's YTM decreases by 10 basis point, means the same basis point, then the PV minus will be 98.782. Calculate the bond's approximate convexity. They have given you the change in YTM also. Convexity formula. P plus P minus 2 into PV0. So P plus is this figure, P minus is this figure, PV0 is this figure, PV0 is this figure, and change in YTM is this figure, 0.001 square. Put down the values and you will get the answer. Please understand what is the meaning of this answer. 35.46. After this point, when you multiply it with change in YTM square, that will be 35.46 into 0.001 square. That will be 0.003546%. This much is the change required in the market price. Change in the market price itself. Very small, because you are not even increasing the YTM by 1%. Convexity is useful only when the difference or the change in the YTM is large. This is very small. Okay, so that's why the answer is 0.003546%. Percent multiplied by 100. Okay, come over to the next topic. A bond has an annual modified duration of 7.020 and an annual convexity of 65.180. This is the convexity. If the bond's YTM decreases by 25 basis point, that means 0.25%, or you can say 0.0025. What is the expected percentage price change? It's very simple. Again, the same formula. Price change. They are saying the price change. So this is going to be the price change minus annual modified duration, change in YTM. And remember one thing, they are saying decreases. If they say decreases, you will have to make sure that you are putting a minus sign while putting change in YTM, because that minus sign will negate this minus sign and the market price will change, will rise by this much of the percent. Okay, so just do the calculation. Convexity is this much and change in YTM square. You might say that why there is no minus sign here, because even if you take the minus sign, the square of minus will be the plus only. That's why they have not showed it there. You can take the minus sign as well. This is going to be the answer. Please understand the logic. 1.755% is what modified duration says will be the change in market price. But after making an adjustment of this much, our answer comes to 1.796%. So after taking into consideration the convexity, the market price should change by 1.796%. The 755% was not that accurate, which 1.796% is. Another part, have a look. A bond has an annual modified duration of this is homework. Same thing. See, the only question of convexity that was asked in exam was the previous one that we took. All these three questions are taken from some other books. That's why you will find it directly given. But this is only for the practice. Institute may ask few more questions, many more questions in the coming time, because they have not asked any question on convexity in the previous exams. So be careful about it. This is an important topic. Question number 88 is over. Question number 89 is going to be the next question. Yeah, you will enjoy this. This is related to the convexity itself, and this is little difficult one. Have a look. Based on the following price information for 4 bonds and assuming that all 4 bonds are trading to 5% yield. 4 bonds, have a look. We will take it slowly, don't worry, we'll give it enough time. So there are 4 bonds with 5% coupon rate, 5% coupon rate, 8% coupon rate and 8% coupon rate. The two 5% coupon rate have different maturity of 4 and 24. 4 years and 25 years. The bond with 8% coupon has 4 years maturity and 25 years maturity. And all the bonds are trading at 5% yield. So if you say 5% yield, this is the current market price. Am I right? See, make it very clear. They are saying that the current yield is 5%. And at current yield, this becomes PV0. Am I right? Okay. Percentage price change based on an initial yield of 5%. Understand, they have already calculated the change in the market price if the yield is changing. See, suppose the YTM is changing from 5% to 5% only. That means if there is no change in the YTM, there is no change in the market price also. But if, how to read it? If the YTM is decreasing by 0.10%, the market price will increase by this much percent in every bond. Getting it? The market price will increase by this much percent in every bond. This is how you should read. Let's say, for example, if the YTM is increasing from 5 to 5.25%, okay, then the market price will decrease by this much percent in every type of bond. Okay, cool. Now, assuming all the bonds are selling to yield 5%, compute the value for C in the convexity equation for each bond using a 25 basis point rate shock. That means you have to consider an increase in the yield by 25 basis point and also the decrease in the yield by 25 basis point. This means that we are giving it a shock by increasing 25.25% and by decreasing 0.25%. That means these figures will help us to calculate PV minus, because the YTM is decreasing. These figure will help us to calculate PV plus, because the YTM is increasing. Okay. What you have to do is very simple. In every type of bond, increase or decrease the market price. Here, since the YTM is decreasing, market price will increase. If the positive number is there, market price will increase. So, understand, this 100 rupees will increase by 0.90%. This 100 will increase by 3.64%. And in such a manner, calculate 8 prices, 4 and 4. All this will be called as PV minus, PV 0 and PV plus. And then with these 12 figures, you can calculate the convexity for each bond. Let's have a look. See, this is they have done it in this manner itself. Okay, understand. I will just show you. 100 plus 0.90%. 100 plus 0.90%. 100.90, right? And yeah, in the same manner, 100 minus 0.89%, minus 0.89% will be these figures, 99.10. So 100 minus 0.89%, 99.11. So I don't know why they have taken it in a 4 decimal. They can just round it off to 11 and cross this, 90 and cross this, etc. In this manner, just add and less deduct those percentages. You will get these three figures. Start putting up in this. You will get four convexity values. Four convexity values. That's it. And this is just the first answer, the convexity. Right? Convexity. This is not the convexity adjustment. Convexity will give you the number only, and convexity adjustment will give you the percentage change required in the market price. Change in the market price. Getting it? Using the value for C computed in part 1. What is the second question? Whatever you have computed in the part 1, compute the convexity adjustment for the 25-year bonds, assuming that the yield changes by 200 basis point. Now there is something which I can say can go wrong because this convexity was calculated with a shock of 25 basis point, and then they are asking us to use this with 200 basis point change. In my opinion, you should have calculated the convexity again with 200 basis point change, a shock of 200 basis point for this bond and this bond. They are clearly saying that you just have to take the two bonds of 25 years. So this value may differ if you take 200 basis point. Let's try it once again. Now what happened is, because the question said that use the value of C computed in part 1, that's why these values were being used here. But you know one thing, that these convexities has been calculated by giving the values a shock of 20 YTM, the shock of 25 basis point. And then the question is asking us what will be the change in market price if the YTM is changing by 2%. So convexity adjustment is very simple, sir. Convexity into change in YTM square. The second equation of change in market price. See, I will show you. In the formula book also, or in the chart also, you can find it. See, there are two parts of the change in market price. This is the first part and this is the second part, and this part is called as convexity adjustment when you multiply convexity with the change in yield square. Okay. Nevertheless, in exam, if this situation comes, you have to do exactly what has been done here. They said use the values of part 1, we will use the values of part 1 and then put a 0.02 square here. And this is going to be the change in the market price. 5.67% and 4.88%. Okay. 200 basis point shock. Now compute the estimated percentage price change using duration of 14.19 and 12.94. What do they mean is this duration? Please mark it there, modified duration. They wanted to say modified duration. How did I know? See, that you may call it as a mistake in the question, but as they used it in the answer, they used it in place of modified duration. We have to compute the estimated price change if we take this as the modified duration, and convexity adjustment for 25-year bond means the same bond that we took in the second part, and if yield changes by 200 basis point. If the yield is changing by 200 basis point, that means we have to use these answers, 5.67 and 4.88, and it's very simple. See, convexity adjustment. %, 25-year bond. Percentage change in market price is equal to, we start with the minus sign, annual modified duration into change in yield plus convexity into change in yield YTM square. Okay, this entire part is called as convexity adjustment, which we have already calculated in the second part. So we'll put a direct figure here. Now, if in this part they have not asked us whether the 200 basis point change is increase in the yield or decrease in the yield. So what we will do, we can calculate both. Take increase in the yield and then find out the answer. See, increase by 200 basis point. How do you write the 200 basis point? 200 basis point, 2% divided by 100, that is 0.02. Annual modified duration for this is 14.19. So minus 14.19. If the yield is increasing, so 0.02 plus convexity for that was this 5%, 25-year bond, 5.67%. I can write it as 0.0567 in decimals, and the answer will be 0.2838, 14.19 into 0.02 plus 0.0567. So that is 22.71%. Okay, that's the first answer. With the same bond, if you decrease 0.02, it will be minus 14.19 into minus 0.02 plus 0.0567. So you just have to put minus sign there if there is a decrease. So 14.19 plus minus negative into 0.02 plus minus negative plus 0.0567. So that's 34.05%. This is only for 5-year bond, 5% 25-year bond. There will be two more answers. Let me just take you to the answer. Yeah. 34.05, 34.05, 22.71% negative answer will be there. 22.71% negative answer. So they have also taken, because it is not clear in the question that whether the 200 basis point is increasing or decreasing, they have written the answer in both ways. So whatever you want to take, you can take it. So I calculated this, you will calculate for this. Nothing is new now. Have you understood? This is the final market price change. And then this will give you the correct figure. Understand the difference. This much was the change suggested by modified duration. But this was inappropriate, or not inappropriate, inaccurate. And this was the adjustment for bringing more accuracy into the equation. So this is going to be the proper answer. Question number 90 and 91 belongs to a concept called as bond immunization. I will just come to the concept sheet. See, we started with question number 76, I think. Value of the bond, duration and volatility, then value of the bond, duration and volatility, duration of the bond by shortcut method, value of the bond, duration and volatility, duration, current yield, YTM, duration, realized yield, duration of the bond, reverse calculation, where we found that 15% was the coupon rate, duration of the bond, then value of the portfolio of the bond and preference shares. These both of them were given as homework. Then come to this point. 86, 87, 88 and 89 were the questions for convexity, and 90 and 91 is the question for bond immunization. So in the next lecture, we are going to start with the bond immunization concept, and it is a small concept. It is not going to take much of the time. And then we will start with the convertible bonds. Convertible debenture and convertible bond is a good and the last concept of your bond valuation, which will go on and on till this point, I think. Yeah, 101. And then some questions of bond refunding will start. I will take one or two and rest will be common questions, so it will go for homework. And then the money market part will start from 107th question, and these are all the small questions, so it won't take much of the time before we finish the entire chapter. So don't worry, in I think coming two to three lectures maximum, the entire chapter will be over. For now, I have understood that this is the lecture where we have seen a lot of questions, so you might be having some kind of a headache. I will also take some break and I will be back with the new concept of bond immunization in the new lecture. For that time, for that time, just be fresh, like be keep yourself fresh. This is going to be another amazing concept that you will love it. And till that time, bye bye from my side.